The items or the inputs purchased for the furtherance of the business is called input, and the tax paid on those input is called input tax. The people who are all registered under the GST purview or under the GST Act, only those people are eligible to claim input tax credit, not any other person. Rent a cab, life insurance, health insurance, except where it is statutory obligatory for an employer to provide such services. Hello everyone, I am Arun Kumar, lecturer in Department of Commerce and Management, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. Dear students, welcome to this new session number 1 on unit number 3, that is input tax credit. So what is this input tax credit and where we are going to use this input tax credit and who are all eligible to claim this input tax credit and what and all the documents they are supposed to obtain to claim input tax credit and how to solve the problems with relating to this particular concept. About this we are going to discuss in this particular session. First we have to understand what is the general meaning of input tax credit. In short we will call it as ITC. Okay, it is not Indian Tobacco Company, it is input tax credit. Okay, so in general input tax credit is the core concept of GST, as GST is destination based tax. Yes, from session 1 relating to GST, we are discussing that GST is a destination based tax. So what is this destination based tax? Destination based tax is nothing but the ultimate user of the product or the ultimate user of the services is liable to pay the GST, not the person who manufacture the product or not the person who provide the service or not any middlemen like the wholesalers or the retailers. It is the particular person who purchase or who consumes the product, that person is liable to pay GST to the government. So that is why GST is called a destination based tax. Okay, so ITC avoids cascading effects of taxes and ensures that tax is collected in the state in which goods or services or both are consumed. Yes, here this ITC input tax credit is going to avoid the cascading effect. Okay, so what is this cascading effect? So if you want to know the meaning of cascading effect, it is simple, it is very easy. So cascading is nothing but tax on tax. For example, here as a manufacturer you will be manufacturing the goods, or to manufacture the goods you will be purchasing the raw materials from the supplier by paying 100 rupees. Okay, and he spent 50 rupees to convert this raw material into finished goods. Fine. So the total cost will be 150. On this 150, let us assume 10% tax. It is 15 rupees. So total 165. Got it? 165. Now what the middleman will do next, or the retailer or the wholesaler will do, the wholesaler purchase this from the manufacturer by paying, let us say, 165 rupees, and you will be adding his profit of 40 rupees or 35 rupees will be adding his profit, and now here the total comes to 200. On this 200, they will be imposing 10% of tax. It comes to 20. So now the total price is 220. Okay, so now the person who will be purchasing that particular item or the product, the final user, you will be getting the product for 220 rupees. So here the particular manufacturer have already paid the tax of 15 rupees. Before that, on raw material 10 rupees or 10%, it comes to 10 rupees. Okay, you already paid 10 rupees plus 15 rupees. Okay, 10 plus 15 plus at the last 20 rupees. Okay, so what is the total tax paid here? So the total tax paid is rupees 45 rupees, right? The total tax paid is 45 rupees. So here we are imposing tax on tax. That means they already imposed 10% on this 100. That 100 rupees is already included in 150, and the 10 rupees of tax is also included here. Again we are putting tax on that. And next year 165, 15 rupees tax is already included in this 165, and again we are putting tax on that 15 rupees amount also. So that means tax on tax. So we are putting tax on tax again and again on the same amount. So to avoid this tax on tax, we have a system called input tax credit, where we are going to avoid the tax on tax system, where the tax will be collected only once for a particular transaction or for a particular process of goods. In GST, input tax credit is nothing but it is a core concept of GST, where GST is a destination based tax, and ITC, that is the input tax credit, is going to avoid the cascading effect of taxes and ensures that the tax is collected in the state in which where the particular goods or services or both are consumed. That means the person who is going to consume is supposed to pay the tax. So ITC makes sure that the consumer of the product or the services is liable to pay the GST, not any other person. This is the general meaning of input tax credit, and the main core idea of this input tax credit is to avoid the cascading effect. That means the tax on tax system what we had, to avoid that they introduced this particular concept. Moving further, the meaning of input tax credit. So in general, you got to know what is input tax credit, why it is introduced, and what is the main objective of input tax credit. So the main objective is to avoid the cascading effect and to make sure that the final user or the final consumer of the product or the services is liable to pay the tax. So if it comes to the meaning of input tax credit, input tax means taxes paid on inward supply of inputs. Yes, input tax is nothing but the taxes paid on inputs. Okay, the taxes paid on inputs or on inward supply of inputs. So now you might have a question or you might have a doubt that what is this input? Okay, what is that? Input. So input is nothing but, for example, you are a manufacturer, you manufacture cars. Okay, you manufacture car. So to manufacture car, you required raw material, no? You required inputs. For example, you required, metal, right? To build the body. You required, let us say tire. You required paint to paint the car. You required glass for windows and all, right? So these are all the inputs, few inputs what you required to produce this car. So you are not manufacturing these all items, you are going to purchase these all items from other persons, right? So these all items what you are going to purchase from other supplier, so these items are called input for your production purpose. Okay, you are manufacturing car. To manufacture car, you are purchasing these all different items from other person. So these all items are called input. Okay, so whatever the tax you pay, okay, for example, you are purchasing metal from a supplier and you pay 10,000 rupees. Okay, on this 10,000 you pay 10% of tax, let us say 1,000. So 1,000 of tax you are paying on this 10,000, total comes to 11,000. So here 1,000 rupees of tax what you paid on this input, that is on metal, that 1,000 is called input tax. Input tax. Okay, so input is nothing but the raw materials purchased for the furtherance of the business is called input, and the tax paid on the input is called input tax. It's very easy and very simple. So input is nothing but the items or the inputs purchased for the furtherance of the business is called input, and the tax paid on those input is called input tax. So that is what the statement says. Input tax means taxes paid on inward supply of inputs, capital goods and services. The taxes paid on inputs are available for set off against the taxes payable on outward supply, outward taxable supply. So here you paid 1,000 rupees. Okay, for example, here you paid 1,000 rupees of input tax and you manufactured the car. Let us assume you manufactured the car and the total cost of the car is, let us say 10,000 rupees or 1 lakh rupees. Okay, 1 lakh rupees. So for 1 lakh you are selling the car and you're imposing 10% of GST. 10% of GST. So how much it comes? 10% of 1 lakh, it is 10,000. Okay. So now you're supposed to remit 10,000 rupees of tax to the government. What you will do? You will not remit 10,000 because at the time of purchasing raw material, you already paid 1,000. No, you already paid 1,000. So you set off that 1,000 and you pay the remaining 9,000 to the government. That's it. So this is called set off of input tax credit. So whatever the input tax you are going to pay, you are going to set off or you are going to adjust that input tax with the output tax or the outward taxable supply. So this is your outward tax, okay, output tax, that is 10,000 rupees you are supposed to pay on the final product, that is on car, but you are not paying 10,000, you are setting off 1,000 rupees of tax which is already paid at the time of purchasing the raw material, and you will be paying the remaining amount of 9,000. This mechanism is called input tax credit. So that is what the statement says. Input tax means taxes paid on inward supply of inputs, capital goods or the services. The taxes paid on inputs are available for set off against the taxes payable on outward taxable supply. So this is the exact meaning of input tax credit. Okay, let us move further. Eligibility and conditions for taking input tax credit under section 16. So eligibility and conditions for taking input tax credit. So if you are a manufacturer, if you are running any manufacturing unit, you will be purchasing the raw materials or the inputs from outside to produce a final product. So if you want to claim that input tax, what and all you paid on purchase of inputs at the time of paying the output tax, you are supposed to fulfill certain conditions. Only then you can claim or you are eligible to claim the input tax credit. So what and all the eligibilities we are supposed to fulfill, or what and all the criterias or the conditions we are supposed to fulfill. So if you look into that, the first eligibility or the criteria or the condition is only registered person eligible to take ITC. That means the people who are all registered under the GST purview or under the GST Act, only those people are eligible to claim input tax credit, not any other person. If you are not registered with the GST authority, then you are not eligible to claim input tax credit. If you are registered with the GST authority, then you are eligible to claim input tax credit. So the first condition is you should be a registered dealer. You should be a registered dealer to claim input tax credit, that is ITC. What is the second condition? You should be in possession of tax invoice or debit note or such other tax paying documents as may be prescribed. So if you want to claim input tax credit, you should be in possession of tax invoice. That means if you are purchasing any inputs or raw materials from any other supplier, you should have to take the tax invoice from that particular supplier. Okay, you should have to receive or you should have to take the tax invoice or whatever the debit note you will be issuing. You should be in the possession of that tax invoice. That is the second condition. What is the third condition? You should have received the goods or services or both. Yes, that means you should have to receive or you should have to received the goods or the services. That means you should be in the possession of the goods or the services. If still it is in a transit mode, okay, if still the goods or service in a transit mode, then you are not eligible to claim the input tax credit. The goods or the services, those things should be in your possession. The first thing, you should be a registered dealer. Second thing, you should be in possession of tax invoice or the debit notes prescribed by the authority. Third condition is you should be in the possession of the goods or the services. Fourth condition, the supplier should have actually paid the tax charged in respect of supply to the government. That means the supplier should have actually paid the tax charged in respect of the supply to the government. That means whoever the supplier who is supplying the goods to you, that supplier should have to pay the tax. Whatever the tax collected from you, the tax should have to be remitted to the government by the supplier. Then only you will be eligible to claim the tax. Okay, so you paid the tax amount to the supplier, but supplier yet have not paid the tax amount to the government. Then you will not be eligible to claim your tax amount what you paid on the inputs. The supplier should have to pay the tax to the government. Then only you are eligible to claim the ITC. And one more thing before moving further with the fifth point, this question compulsorily they ask in the exam. In main exam, compulsorily they ask this question for 10 marks. So make sure that you know all 9 to 10 conditions about the eligibility for claiming the ITC. So yes, moving further, fifth point, you should have furnished the return under section 39. Yes, that means as a particular manufacturer or as a registered person, you have to furnish the details or the returns under section 39. Then only you are eligible to claim ITC. Next, when goods are received in installments, ITC can claim only when at the last lot is received. That means if you are purchasing the goods from your supplier, if you are purchasing the goods on installment basis, only you can claim the ITC if you are receiving the last installment. Okay, only you can claim the ITC only after receiving the last lot of product or the services. So if you are purchasing any goods on installment basis, only you can claim ITC only at the time of receiving the last lot of installment. Next, no ITC will be allowed if depreciation has been claimed on tax components of capital goods. If you are purchasing any capital goods for your business purpose, okay, you are purchasing some machinery, okay, that is called capital goods. So if you are purchasing any machinery, if you want to claim ITC, you can't claim depreciation. If you already claimed depreciation, you can't claim ITC. Either you will be claiming input tax credit on your capital goods or the depreciation. If depreciation is already claimed, then you are not eligible to claim ITC, that is input tax credit, on any capital goods purchased in that particular financial year. Next, where the goods against an invoice are received in lots or installments, the registered person shall be entitled to take credit upon receipt of the last lot or installment. Again, if you are purchasing any goods or services in lots or in installment basis, only at the last lot received, okay, only you can claim the ITC after receiving the last lot or the last installment of goods. The same as the sixth point. Next, the payment should have been made within 180 days from the date of issue of invoice. So here the particular person should have to make the payment within 182 days or 180 days from the date of issue of invoice. So if you have already paid before 180 days of date of issue of invoice, then you are eligible to claim ITC, that is input tax credit. If you delays, okay, if you delays or if you make delay in payment to the supplier, if you make the payments after 180 days, then you are not eligible to claim ITC. So you are supposed to clear your bills to the supplier within 180 days, then only you are eligible to claim ITC. So these are all the eligibility criteria and the conditions to claim ITC as a registered dealer under the GST purview. So next, moving further, ineligibility input tax credit, section 17 subsection 5. That means in the previous slide we got to know who are all eligible to claim ITC. So in this slide we will be discussing about who are all ineligible to claim ITC, that is input tax credit. So who are all ineligible to claim ITC? Motor vehicles, except when they are supplied in the course of business. Yes, if they are purchasing the motor vehicle for the purpose of business, then they can claim the ITC under the capital goods. If they are purchasing motor vehicles for their personal purpose, okay, then they are not eligible to claim ITC on those kind of capital goods. So if the vehicles are purchased, if that is purchased only for the business purpose, then fine, they can claim the ITC. If it is purchased for personal purpose, then ITC is not available on those capital goods, that is on motor vehicles. Next, membership of a club or health and fitness center. Yes, if you are paying membership fees and if your particular person who is providing that health facility or club facility or the fitness center facility, he can't claim the ITC. So on these facilities, ITC is not available. Next, rent a cab, life insurance, health insurance, except where it is statutory obligatory for an employer to provide such services. See, if you are renting a cab or if you are taking a health insurance or the life insurance, you can't claim it as a input tax credit. In case if your employer is providing to you, then the employer can claim it as a input tax credit. If you want to claim it, if it is his responsibility, then you can claim it as a ITC. Then if he is simply paying from his pocket as a responsible person or as a responsible employer, then you can't claim it as a ITC. You can't claim ITC for that particular facility what is giving to his customers. Next, travel benefits extended to employees on vacation such as leave or home travel concession. Yes, if any travel facility provided by the employer to his employee, okay, on that the employer can't claim ITC because it is given out of the the rules made by the GST authority. Here for his satisfaction or for the customer or for the employee satisfaction, the employer is giving some traveling facility, he is sending them to some tour or for some weekend parties or somewhere. So it is up to him to send the employees or not to send. If he is sending the employees for travel purpose and on that whatever the expenditure he will be incurring, on that no ITC will be provided for the employer. Next, goods and services on which tax has been paid under composition scheme. So we have a system called composition scheme where they will be charging very less percentage of GST like 1%, 2% or 3% max to max. So if you comes under the composition scheme, then you are not eligible to claim input tax credit. And the sixth point, tax paid after deduction of fraud, willful misstatement or suppression. Yes, here if you intentionally provide some illegal documents and all, and if you are paying after a fraud, if you are paying the tax after making some fraud and all, so at that time you are not eligible to claim the input tax credit. See, if you have a clean sheet, if you have all the proper documents and all, then you can go with ITC, claiming of ITC. So you are maintaining some misappropriate statements or you provided some illegal documents and all, fake documents. So ITC or the GST authority, they got to know and they send you a notice, then they made you to pay the tax. Whatever the tax you are paying, you can't claim it as ITC because after the fraud you made, the authority got to know and now they are making you to pay the tax. So in that situation, you are not eligible to claim ITC. And tax paid for release of detained or seized goods. Yes, if any goods are seized by the authority and if you are paying the tax to release that seized goods, so that tax can't be claimed as ITC. So these are all the different situations where you can't claim or you are not eligible to claim input tax credit, and they might ask this question also in the exam, so you have to concentrate on this aspect also. Next, moving further, the documents for availing ITC. So yes, what and all the documents you required to avail ITC? If you want to get ITC, what and all the documents you are supposed to submit? The first one is tax invoice issued by the supplier. Yes, if you are purchasing the goods from the supplier, you should have to get the tax invoice from the supplier and you should be in the possession of the tax invoice, then only you are eligible to claim ITC. Next, tax invoice self, that is reverse charge. Reverse charge is nothing but, for example, you are a registered dealer. You are a registered dealer under the GST purview and the person who is supplying the goods to you is not a registered dealer. Okay, the person who is supplying goods to you is not a registered dealer. At that time, you only have to raise the tax invoice because you will not be having the right to collect the tax. Okay, you will not be having the right to collect the tax as he is a unregistered dealer under the GST authority or under the GST purview. So what you are supposed to do, as a registered dealer, you only have to raise the tax invoice. If he is only a registered person, then he will only raise the tax invoice. Here he is not a registered person, but as a purchaser, you are a registered person, you have to raise the self-tax invoice. So you should be in the position of the self-tax invoice. Next, debit note issued by the supplier. See, if any debit note is issued by the supplier, you should be in the possession of the debit note. Then only you are eligible to claim the ITC. Next, bill of entry, that is imports. If you are importing any products or any services, then obviously you should have to obtain the bill of entry to claim ITC. And invoice or credit note issued by the ISD, that is input service distributor. So you are supposed to be in the obtain of invoice or credit note issued by the ISD. ISD is nothing but input service distributor. So these are all the documents required for claiming or availing the input tax credit. And they might ask this question for 2 marks in the main exam. So to make sure that you know all these points to score 2 marks. Moving further, set off of ITC. So what is the set off of ITC? So we all know in GST mainly we have 3 types. One is SGST, second one is CGST, and the third one is IGST. Okay, so you will be paying tax to the government. You will be paying CGST or SGST or IGST. For example, if you have excess amount in SGST, okay, if you have excess amount in SGST, you can set off that excess amount with IGST. IGST. Okay, if you have excess amount with your SGST account, you can set off that excess amount with IGST. Next, CGST. If you have excess amount in CGST, you can claim for IGST. Okay, if you have excess amount for CGST, you can set off the IGST amount. Okay, next IGST, you can set off first CGST, still you have excess amount, you can go with SGST. So this is how we are going to set off. If you have excess amount in SGST, you will set off IGST. If you have excess amount in CGST, you will set off IGST. If you have excess amount in IGST, first you will set off CGST, then you will set off SGST. So this is the way how we are going to set off the amount of different taxes, that is CGST, SGST and IGST. For example, here under SGST, you have 2000 rupees. Let us say you have 2000 rupees. Under CGST, you have 3000 rupees. And under IGST, you have minus 4000 rupees. That means in your account, you have plus 2000 under SGST account, under CGST account, you have 3000. But here under IGST account, still you have to pay 4000 rupees to the GST authority. So you can pay this 4000 by using this SGST and CGST. So you can use this 2000 to pay that 4000. See here, you can take this 2000 here. Still how much you are supposed to pay? 2000. So now here the account will be nil because you use this amount to set off this, right? Next, here we have 3000. So in 3000 take 2000 here. So now the tax payable under IGST is nil. Under this CGST still you have 1000 rupees. Right. So this is how you are going to set off the different taxes under GST against the different taxes, that is CGST, SGST and IGST. So with this, I'm going to wind up this session. I'll come up with few more topics with respect to this input tax credit concept, and we will also solve a few more problems in the upcoming sessions. Until then, thank you all. Have a nice day. Namaste.